The pocket pivot is a buying signal that's used before explosive movements up. It comes from bases and in the movements of long uptrends. What we're going to do is look at what it is, how it works, where it came from, and 3 examples of how it's been used recently on the ASX. If you want more details, you can click on the summary sheet in the link below to download it. You can also like the video to support the channel, click subscribe for updates, and comment below to let us know how you're using the pocket pivot signals or how you're using other signals that get a similar outcome. So what we're going to do today is walk through and see what is a pocket pivot. Now look at the authors and where it came from, who made it, who designed it, why use pocket pivots, the key points, the market leaders scanning and why that's important, and then 3 examples, Novonix, Poseidon and Elders, to see how it's been used in recent times. Now, the pocket pivot, what is it? Well, it's a volume signature of when large institutions are accumulating a share or a stock. So this buying happens in a consolidation or in an uptrend. Now the authors of the pocket pivot have it in this book, Gil Morales and Chris Kacher, detailed in the trading cockpit with O'Neill's disciples, strategies that made us 18,000% in the stock market. But this is a follow-up to their other book, which is how we made $18,000% in the stock market. 2 great books, both cover the pocket pivot in detail. This one here goes through in more examples, and we've extracted some quotes to help understand it. The first one comes from Chris Kacher. He says, "The premise of the pocket pivot is simple. If it is buying of institution that carves out the bottom of a constructive base from which a stock may break out to new highs later on, then we can postulate that the clues of buying and accumulation on the lower parts of a stock's chart begin taking a position, particularly if the stock is proven to be a market leader." Now this is from page 128 of the book that we just looked at before, and what we're going to do is work into some examples. But what we want to do is understand how these 2 came up with the idea of pocket pivots. They call themselves O'Neill disciples because they were working with William O'Neill, who's well known for Investors Business Daily and his CANSLIM method. That's a method for another video, and quite an in-depth one because it's a phenomenal method. What they're doing is using the pocket pivot on top of that CANSLIM methodology. That does run through filtering, profits, earnings, and the like. So there's a whole filtering process to that. The pocket pivot was then used in the choppy markets, or was born out of the choppy markets of 2004 through 2005. What was happening is they were getting whipsawed in and out of positions from the CANSLIM method. And if we use this chart here as an example, CANSLIM would probably be buying around this level here, this overhead resistance line. Whereas the first pocket and second pocket on this chart show the pocket pivots here as the accumulation stages. The points that are being accumulated with these high volume levels down here, and that becomes the buy signal to get in at a much lower risk entry. The stops might be down around here, or you can see on the chart, as opposed to entering up here and having to stop down around these levels. So it's a lower risk entry for quite possibly more upside than what the CANSLIM method was providing in 2004 and 5, and many successful traders have used it since. So it's really just the early entry on top of that CANSLIM method and stock selection process. The key points that we see for the pocket pivot is that it comes out of constructive basing patterns. So the pocket pivot will come from within a congestion or a consolidation, and the volume signature is a critical component because the large volume of buying in that consolidation period is what we're looking for, and that's highlighting institutional support. So it's identifying institutional footprints within a base or an uptrend, and we want to note that it's in a favourable stage. A bit like the CANSLIM method, we want the chart to be showing that it's in a profitable part of the stage or where it has an upward movement. We're talking about Stan Weinstein's 4 stages here, which is another great book and another video to delve into at another time. But what we're saying here is that pocket pivots can come up quite often, but you want it to be, although how it's described in the book, is to come from the backdrop of a good, strong foundations of a company, which the CANSLIM method's overarching, or the 4 stages of Stan Weinstein. When we have a look at the volume, this critical component of the volume signature in the pocket pivot, we want to see that the volume on the pocket pivot is larger than the largest down day of the preceding 10 days. So you want to see that volume spike up on the pocket pivot day be higher than the preceding 10 days, down days. So what we're saying here is we're excluding the volume of the up days. We can have a large update within that 10-day period, and that doesn't negate this being a pocket pivot. You also don't want it to be overextended, and that's where we come over to have a look at the 10-day moving average. So pocket pivots that begin their move from a point that is above the 10-day moving average are deemed as extended and have higher risk. That's from page 160 of the book that we're looking at here, Trading in the Cockpit. We'll look at the 10-day moving average, and we've got an example of an exception to see how that may work. But that overarching rule, you want what the book states in CANSLIM, Stan Weinstein, Thomas Bulkowski, and Jesse Livermore from 100 years ago. They're all talking about investing in market leaders, to trade the market leaders. When we're talking about trading market leaders, these are strong stocks. They're leading the market to provide better trading opportunities. In short, and we'll see this on the examples, the 10-day moving average is above the 50-day, is above the 200-day moving average. What that pretty much means is that the stock or the share price is going up, in short. This is what we're consistently doing on Finer Market Points. We're surfacing those leading thematics, so the leading industries with market dominance, and we're finding the top 6 companies, the best performing companies within that industry. We're surfacing that in Finer Market Points and shares in play, and then applying technical analysis like we're doing now to find pocket pivots and other opportunities to identify in those top companies that are consistently leading the market higher. Here we move over to the first example. Novonix NVX has been a favoured trading share for the last year or so. We've seen the interest in lithium-ion batteries and all the battery minerals that go into it. Novonix has been a great beneficiary of these trading movements. We've highlighted here on the arrow the day of a pocket pivot, and it shows here it corresponds with a very high volume day that stands out. We don't need to calculate the 10 days because it is such a high volume day in comparison to the preceding months. Now, critically, the blue line is a 10-day moving average. That's above the green line, the 50-day moving average, and then it's above the red line, the 200-day moving average. The importance here is that that's showing that the stock is starting to trend up. Now you can see it has been trending down, almost touched the 200-day moving average. Whether this creates a volatility contraction pattern or not, it's up to your own definition. You can click on the link below to look at the tutorial and walkthrough of Mark Binavini's volatility contraction patterns. But these could be one contraction here, so whether that's 1, 2, 3, sitting on the 50-day moving average now, coming back above it, and the number 4 is very tight. This is that congestion pattern here. In the context of a larger congestion pattern here, if you bring this out to have a look at the weekly over a couple of years or the year itself as a volatile year, then it trades out. So it breaks out of this volatility contraction pattern over a swing high, swing high, swing high, all in one day, one long, strong candle, one strong bar, huge volume breakout, and then starts the movement from sort of the 220, 30 period levels all the way up to over $4 in about a month and a half. Very strong explosive movement and a good pocket pivot and a great example to start with. This is kind of a textbook example to start with, coming out of the base, 10-day over the 50-day, over the 200-day, and then that candle sitting within the 10-day. This is textbook. This is what you'll see most descriptions. Next, we're going to have a look at some exceptions. The next example is Poseidon Nickel. Now, for those who are students of history, especially those on the ASX, they'll recognise this name of Poseidon Nickel. This is a different company, but it's a great one to look up if you want to know the history of some explosive companies in the years gone by. And if you've got a daily chart, I'd love to see how many pocket pivots were in the Poseidon Nickel of many decades ago. Here we see the pocket pivot is coming from under the 200-day moving average. So this red line here is above where the consolidation has been happening. Now, when you see the 50 and the 200-day crossover, that shows indecision within the price. This is not as strong as Novonix was, but it is, whether that's a VCP or not necessarily as big or defined, but it is coming down. Think of the bouncing ball, one big bounce, second bounce, third, and then a fourth tiny one here on that 200-day moving average. You can see it's been support here. Now, as the 50-day comes under that, it turns into a gold cross back here. But the point that we're looking at today is this mid-range close for the day. So it didn't close at its highs, closed about mid-range, but definitely gapped up from the trade of the day before. What's here, so you see the volume, it's still significant. We don't need to calculate back to see whether it was a high or the highest within 10 days against any down days. Quite evident, but it is under that 10-day moving average when it starts to break out and then closes just on the 200-day moving average. It's what they normally want to see, talking about the book. You want to have a strong close, so like this kind of candle here, or trading up here towards the closing up near the highs, but it does close down around the 200-day moving average. But the 50-day, this green line, is below the 200-day moving average, which is a critical component. However, there are exceptions that they'll refer to in the book, and that's because there's a huge volume here, breaking out and closing above the 10, 50 and 200-day moving average. That's one of the exceptions that Gil Morales and Chris Kacher will talk about in the book. The final example that we're looking at is ELD, and it's only a couple of weeks old, not even 2 weeks. What we're looking at here is elders coming in on the base. Now we do see the blue line, the 10-day moving average, is sitting above the 50-day, the green line, and then above the red line being the 200-day. So it was stacked and it was moving upwards in that definition of how the moving averages were stacked. Although it's trading within this box here, these are the 10 trading days that we're looking at, and the corresponding volumes pointed out down below. We had to get in and zoom in to see that this only just tipped out these volume candles here. I'll go back so you can see. Now this is critical because the candle here on the breakout, the pocket pivot day, is coming from within a base. Within this congestion here, if you draw the congestion out further, that's another way to count it. This is these tight closes here, within the highs, within the low. The candle starts within here, but does not touch this blue line. It's not within the 10-day moving average. So by definition, that's overextended. However, in the book, they will reference, Gil Morales and Chris Kacher reference that if it's within the congestion period, then that can be an exception to trade. And you can see that it has traded favorably and broken out and traded up over the next couple of days. That's a good example of a pocket pivot, but how the exceptions that are referenced in the book can be applied in the current market conditions. Again, the main point to look at with pocket pivots is that you've got the fundamentals stacked right. Using the CANSLIM methodology does help, whether it's Jesse Livermore that we're following instead, or Mark Minervini's approach to filtering out the companies. That's what we're surfacing on final market points, and we're putting forward in the shares in play, top 6 best performing companies in those leading thematics. Because as all of these professional traders have noted in their books, or however you want to get their information, is that leading companies don't move alone. They move in groups, they move in herds, they're sister companies, their industries, their thematics, and they're critical points that we're consistently servicing. So you can like the video to support the channel, click subscribe for updates, or comment below to let us know how and what you're trading.